Hello, welcome back. We're going to talk about Occidental Petroleum Corporation, a company that you may have recently heard of, mainly because of Warren Buffett buying a large stake in the company. And I wanted to talk about this and examine the financials and see whether it's a potentially interesting buy for us. Now, companies of that sort, and this is very, very important to understand, companies like oil companies are very, very cyclical in nature. So there are times when the company's stock prices can go really, really high and times when they can go really, really low. And so you have to be entering at the correct time. And that time is actually before the boom and making sure that the company is not going to go bust. These kinds of companies are kind of called boom and bust companies. So they tend to go up and down, and you only have to make sure that you're not entering a company that's gonna be bankrupt, which is what happened with a lot of oil companies back in 2020. It's like a couple of years ago. Now, as you can currently see in here, the company is enjoying a lot of growth in terms of its stock price, and that can be tempting for you to enter. The thing to understand is that because of the cyclical nature of these kinds of investments, it really pays to enter early. Like for instance, you couldn't really enter here because you didn't know that it would reverse, but maybe around here would be a beneficial entry, like 20 or 15 or something of that sort. But right now the company is at 55, and so is it worthwhile? Now, there are a couple of things that are very, very important to understand, and I want you to take a look at this piece of information here, this couple of pieces really. The first one is that I can actually sold off his Occidental Petroleum, which I think is a very good timing really to sell, just because it has been enjoying a lot of growth, and at some point, this situation will reverse. It's always the case. Again, it's a very, very cyclical investment, and you kind of want to reap the benefits. And I think he almost like quadrupled or plus his investment, so that was a good time to exit. And now you will see that Warren Buffett actually invested in Occidental Petroleum, but there is a little bit of a difference here. You will see that Berkshire owns 100,000 preferred shares in Occidental, and they do own common shares as well. But they do own 100,000 preferred shares, which pay them an 8% annual dividend. And in case you don't know how these preferred shares work, they're like a combination of a stock and a bond. They're paying a fixed income, really, every year. And it's also actually even possible to pay with stock instead of cash. And this is exactly what Occidental had to do back in 2020 because guess what? They didn't have cash. And so this is something to bear in mind because this extracts $100 million of free cash flow from the company. And I was curious to see the details about the preferred dividends here, so I took a look at the 10K. And you will see here that in the stockholders' equity section of the balance sheet in 2021 over here, the preferred stock is 100,000 shares and it's priced at $10 billion almost over here. And as I was looking at the tool that I like to use, you will see here that the balance sheet, sorry, the income statement is where it shows. In the income statement, you will see that the preferred dividends that were paid were $810 million. And it doesn't actually show you the number here, the actual amount of in billions, but it does show on the tool that I have created. And you will see here that the preferred stock is sitting at $10 billion right now. So this is something to really bear in mind because this extracts value from your free cash flow. And as you see here, the free cash flow of the company, you will see that we are looking at a company that is increasing its free cash flow here. But again, you have to bear in mind that there are two things happening. 2021 is a booming year for the industry really, and this is why you are seeing a massive difference. This can easily go back down to these levels or less actually, and it will keep extracting 800 million in free cash flow from the company. And the other things that you want to be examining, of course, is things like the total assets of the company, which seem to be increasing, which is a good thing. Total liabilities of about $54 billion, which is a lot of liabilities really compared to the free cash flow that the company is making, and the total equity of about 20, which seems to be the same as it was in 2017. The multiples of the company are sitting at cool levels, nice levels. The profitability is sitting at about 15%. I guess about fair for this kind of company. and a solvency rating of debt to equity of 153%. So there's quite some debt for the company, and that's not great, of course. And remember, when you are holding common stock, it's always paid after preferred stock is paid, and preferred stock is actually paid after bond payments are paid, for example, after these kinds of instruments. And so this is the hierarchy, really. So if you are owning common stock, you're going to be paid last. This is how it is. And so this is something that is really important for these kinds of companies that are issuing a lot of preferred stock and paying hefty dividends, hefty preferred dividends. Because if you are Warren Buffett, you really like this situation, because you are making some really nice income here. 8% annual dividend is great. I mean, basically in about 10 years, you're gonna get 80% of your capital back, and that also includes the extra that you're gonna be making potentially from the share depreciation. But you as an investor, if you enter right now and you buy common stock instead of preferred ones, what you are going to see here is that if I examine the dividend for you, which is the common investor, you will be making 0.07%, which is like nothing. And so you would basically be all about the companies appreciating in price. And the thing is, as I mentioned earlier, it has already more than quadrupled from what it was back in 2020. And at some point, the reversal will happen, because again, these kinds of companies are very cyclical in nature. And so you have to bear in mind and think about it a little bit. Do you actually want to risk it and buy at a high price and risk a potential reversal that's going to happen at any point, and have a company that's actually paying a lot of its free cash flow to Warren Buffett just because he has the preferred dividends? So in my case, I personally wouldn't invest in this company. I don't know why this is not loading, by the way. It probably has no dividends here, no dividend information, I suppose, just because this is close to zero. But the important thing to note here is that as an investor, as a retail investor, you may be looking at Warren Buffett and be like, okay, Warren Buffett bought this, so I should buy it. I mean, if Warren Buffett bought it, why not myself? I mean, he knows better, doesn't he? Well, he has different types of agreements with the company, though, and he has different instruments as well. He does have common stock too, but he has a lot of preferred ones as well, and probably the whole thing, really, the whole pie. And so this is a point where you have to think to yourself, okay, is it really worth it to enter at these levels here to gain what, like to go maybe to 90? Maybe it can happen. It could happen. But if you decide to enter at this level, you'd have to at some point think that you should be exiting, maybe if the company reaches these levels. Because myself, I wouldn't really hold a company that is very cyclical again in nature for such a long period of time, especially when a lot of its free cash flow is paid back to Warren Buffett or potentially other investors that have invested in preferred dividends, really, in preferred stocks. So in this case, it seems like it's only Warren Buffett, based on what we're looking at the 10K. And so this is what I wanted to talk about in terms of Occidental. Just bear in mind, be a little bit cautious in case you're looking at the company's like 5-day chart, and it's going great and it's going higher and higher. It had like a 20%, 25% gain or something like that yesterday or so. And so you're looking at that and you're like, okay, it's growing higher and higher, so I need to enter, have fear of missing out. But then again, if you take a closer look at the financials, you may want to be a little bit more cautious about this. Just wanted to inform you and let you know about it, and it's obviously your decision at the very end. Thank you for watching this video. I hope you enjoyed. If you did learn something here, and if it did help you a little bit, this video, please leave a like, because that really helps the channel grow, and consider subscribing, because I'm making tons of videos, and I can potentially provide some value to you and your investing. Thank you for watching this one, and in case you're interested in this type of content, you may want to take a look at the video that I made earlier, and it's about Bed Bath & Beyond and today's 30+% rise, and whether it's a worthwhile opportunity. Thanks for watching this one again, guys, and I'll see you very soon. Bye bye.